Every auto lender has a leak nobody's watching. Not fraud, not bad underwriting. It's what happens after the loan goes bad. A total loss, repo, a gap claim, a car that sits in impound. The next 3 minutes, the 5 recovery functions that quietly drain a portfolio. None of this is glamorous, so it's usually the first thing understaffed. Picture a total loss landing on someone's desk Friday. Nobody touches it till Monday. And that's the first of 5 clocks now running against the account. An automated services provider sells 4 things: tech, strategy, specialist knowledge, and someone actually doing the work. Gap claims sound simple. Insurance falls short, gap covers the gap. But every provider wants a different packet, a different deadline. Miss one window, and that claim isn't delayed. It gets denied. Now you've got a deficiency balance and a complaint. This is really a documentation problem wearing a finance costume. Total loss is where I think most lenders lose money without realizing it. Specifically, step 2. Insurers don't always hand you the right number on the first try. Deconstructing that valuation and pushing back with market data routinely recovers more than the original offer. And a no pay isn't an automatic write-off either. Screenshot this one. Nearly half of repossessed vehicles have damage that never gets pursued as a claim. It just quietly comes off the resale price and lands on the consumer's deficiency balance. And it's not only forward-looking. A 2-year look-back means claiming damage on vehicles you already sold. Recovery you assumed was gone. Diminished value is the one nobody outside of remarketing thinks about. Repaired doesn't mean restored to full value, and that gap is recoverable from the at-fault party's insurance. The workflow is almost absurdly low lift. You send a VIN, that's it, and you can chase it whether the car's still on lease or sold years ago. Impounds are a volume of relationships problem. Notices come from tow yards, police, state, and federal agencies, all different formats, all at different clocks, and fees pile up every day a vehicle sits. A provider that's resolved 50,000 plus of these knows which facilities negotiate. That's not something a small team catches up to fast. Take this checklist into your next vendor call. Ask specifically about lookback. That one question separates providers who will go recover money for you or those who already wrote them off. And ask about breadth, because managing 5 vendors across 5 functions means you're doing their integration work. You don't need data team for this. 6 numbers, tracked monthly, tell you almost everything. Watch deficiency balance trend first, because it's a scoreboard. Every other metric here is really just an input into that one number going down instead of up. That's the 3-minute version of this. Deeper problem. The full playbook goes much further into everything. You're going to get a complete buyer's checklist, 30, 60, 90-day rollout plan, and the links below. The Automated Recovery Playbook. If this was useful, subscribe. One auto finance operation breakdown like this every week. Thank you. See you in the